We got you on a good day because people are talking about at least value in software, specifically enterprise. I wonder if the deals this morning have caught your eye and feed your overall thesis.
Well, they do. These are cash buyers hoping for a double-digit return for their investors. So we view that as a good check on valuations. At Oakmark, we've been using private market valuations as a part of our triangulation of value for companies for some time. If you look at the Coupa deal, for instance, and compare it to a company like Amazon, of course, they're very different. But the cloud business, Coupa is a cloud software company, and Amazon powers these cloud software companies that are growing. Coupa was bought for 8.4 times forward revenues. If you put 8.4 times on Amazon Web Services, which is more profitable and growing faster than Coupa, that gets you to roughly $850 billion. And Amazon's enterprise value today is only $900 billion. So you're paying next to nothing for the retail operations.
Right. And when you look at, I know you've long held Alphabet, you're watching CRM and Amazon. What about the notion, though, that they need to cut a lot of fat before they start to get into next year, that there's essentially bloated because of the build-out they got from COVID?
Yeah, that's a great point. A lot of the expense growth at these two companies was related to the enormous growth they had coming out of the COVID recession. But part of it also is very company specific. So at Amazon, the controversy is retail margins. They doubled their fulfillment capacity over the last 3 years. They did this 10 years ago when we owned it to develop second-day prime delivery. Now they're working on same-day delivery. In both cases, we think these are smart investments and the right thing to do, but they're going to have to lever these investments. Google, they grew 40% in 2021. And with that came a lot more spending. Some of it may have been hubris. Some of it might have been related to that growth. But both companies seem very serious about getting their margins back up to where they were. And it's not rocket science. And these companies have plenty of brain power.
So, Tony, whether it's tech or whether it's financials, which I know you have a lot of those names in the fund as well, is the value still there if we go into a recession next year?
At Oakmark, we don't try to predict where the macro's going. We look at it like if you and I, Morgan, owned a business together, we wouldn't think it's going to be worth a lot less if we were going to go into recession next year or in year 3. That's just the normal ebbs and flows of things, and real business owners wouldn't think of it that way, and we don't at Oakmark.
Tony, I want to come back to Alphabet for a minute because I could have gone back a year or 2 years. It's always seemingly cheap, at least versus its growth rate. And so I'd just like to understand the catalyst. And I know you guys have owned it for quite some time. Is it because you do think that they're going to have more of a focus on costs? It's going to increase margins? What is the catalyst here that you see? Because, again, you could have said it's cheap a year ago or 2 years ago. And obviously you would have been right sometimes, but you wouldn't have been right over the last year.
That's exactly right. That's part of the reason, David, it's been a good stock is that it's looked reasonably valued and the fundamentals have been good. Over the last year, this sort of company has been falling out of favor. There's been this tech wreck. And the fundamentals, they're lapping some very large growth, and the market doesn't like slowing growth rates. That's my best guess as to why Amazon is down, Google is down. I don't know what the catalyst is going to be at Oakmark. We don't focus on catalysts. We focus on business value and the fundamentals and the valuation of those companies. And in the case of Google, it's looking like it's selling at a market multiple on forward earnings. But the growth is much higher. And when you peel back the onion, you net out the cash on the balance sheet, the other bets losses, and the Google Cloud investments. You value Google Cloud where it would trade as a public company, and you're paying 10, 11 times for the core search and YouTube business. That's just a terrific value.
What about the notion that the bear thesis that inflation, CPI, we can wring our hands about it a lot, but it's really in the past. What's going to happen now is a come to Jesus moment on earnings for next year, and in the view of some, that's going to lead us to maybe fresh lows in the S&P. I know you're company specific, but does that argument hold water to you?
If the fundamentals are much worse than people expect at large, that's probably not good for equities. At Oakmark, we don't spend too much time thinking about that because we don't believe we have an edge outguessing people and things like that. We believe our edge is is estimating business value, not guessing where stock prices are going.
Tony, appreciate it. Great to talk to you again. Talk soon. Tony Coniaris over at Oakmark.